It's been a week littered with volatility, with fears over AI disruption sparking a massive rotation out of tech. So let's talk big picture and discuss how investors should react during times of uncertainty. Joining me now is Lauren Sprung, Midland Financial founder and author of Financial Planning Made Personal, for this week's FA Corner, brought to you by Capital Group. Larry, what a stressful time in the markets, right? And we have seen this selling pressure, but we've also seen this sort of unrelenting news flow this year. And so I'm sure you're getting a lot of calls from people who are freaked out and trying to figure out what to do amidst this backdrop, right?
Yeah, I think what you're seeing is, to your point, volatility is because of uncertainty typically. And we're seeing a lot of uncertainty, right? We had uncertainty around who was going to be the new Fed chair. We've had uncertainty around AI and tech spending. So that increases volatility. I think in terms of long-term plans and projections, those remain on target. If you're a little bit more of a trader, then you have to be able to digest these pieces of information as they come.
And when we look at the things that we maybe do think we know this year, I mean, we think we know there are going to be some rate cuts. The number, you can debate, right? You think, the economy is sort of on a little bit delicate footing, especially the job market. So how do you sort of take some of that stuff and form a strategy with it?
Yeah, so I think we're in alignment. We're thinking there's going to be rate cuts, maybe one, maybe two, who knows? That's out of our control. I don't know that the job market is softening as much as we're hearing and experiencing in the headlines. But I think there are certain areas that are definitely softening. I think when you look at the long-term effects or even the short-term effects of any of this on the markets, we have to see what the impact is going to be and what the projections are, right? And what I mean by that is I don't believe we're heading towards a recession, which if you look at some of this data, if you follow the breadcrumbs, that's what it's kind of leading us to believe. But I don't think we're there. Consumer spending is still pretty strong. Sentiment is a little bit down, but I think as a whole, I think the economy is positioned pretty well. And I think what we're seeing is a little bit of a pullback off of those COVID highs that we saw just a few years ago.
Okay, and then, I imagine some of the people who are calling you as all of this is going on and as they're worried want to lighten positions, right? I mean, or what are you hearing from clients and what do you tell them?
Ironically enough, we're not getting a lot of calls because we position a lot of our families for more long-term perspective. Most of them don't have short-term really perspective. So what we've done is designed a long-term game plan for them and have already bucketed out their money for their short-term needs, medium and long-term. So where this volatility is really affecting them is more in that long-term. So they have the time horizon to really withstand this volatility. Their short-term bucket, which is really funding their needs and wants today and for the next 12 to 18 months, is fairly liquid and available and not at the risk of the market, so to speak. So those calls are not necessarily coming in, and we're not making fundamental changes. We are making minor tweaks to their portfolios because we definitely feel minor adjustments can lead to major improvements, but there's not this holistic need to make overarching changes because of the strategies we've implemented.
And I know you quoted a stat to me when we were talking about this. That's one that our friend Ryan Dietrich talks about a lot. I've seen it elsewhere as well, that if you end up selling and you don't participate over the long term in the market, your returns are significantly worse over time. Yeah,
they're abysmal. I mean, if you look at it, most down and up days are clustered together. Since 2000, if you invested in just the S&P, you averaged 9.8% return. But if you just miss the 10 best days over that period, just 10 days, your return goes to a negative 12.5%.
And that's on an annual basis.
Correct.
Yeah.
Correct. Yeah. So it has a wide swing and shows you the vast difference between staying fully invested and committed to your investment thesis versus trying to time things and going in and out. It's not that fruitful, especially most people are not professional traders that they can time that really effectively.
You mentioned minor tweaks. Like, how do you know where to make those tweaks? How do you think about when to do that in this kind of environment?
So we rely heavily on our investment team and what their outlook is. So for example, one tweak that we've made recently is looking at portfolios. 3 years ago, we started taking a position, our team, in gold. Now, we got a little bit lucky there, and sometimes you'd rather be lucky than good. But at this point, because of the huge run-up that we've seen there, we are trimming those back a little bit. We are allocating a little more to international, and peeling those, because those have experienced, explosive gains also. So it's a matter of, avoiding those instances where you want to let those gains run, but at the same time, you also have to take profits, otherwise you never do, right?
Right, and it's interesting. I was going to ask you where you're putting them, so it's interesting that going into international is the area where you're reallocating that capital.
Yeah, I mean, international is an area that we feel in the next 12 months is going to be pretty fruitful for the markets, even if the U.S. is a little bit softer. But again, we're looking, our team is evaluating this every day, and we're making adjustments quarterly to the portfolios. Now, it doesn't change their overall thesis for the family, but underlying in those specific strategies, we are making changes.
Gotcha. Larry, thanks so much. Good to see you. Appreciate it. And that was FA Corner, brought to you by Capital Group. Coming up, Super Bowl betting is on the rise. I'll talk to the CEO of FanDuel next. Plus, how Bad Bunny's Super Bowl halftime show could stack up to years past. That's next on Market Catalyst.